Trading your starter, booster and anchor positions. If you have ever entered a trade only to watch price move slightly against you before heading exactly where you expected, you already understand why position building matters. Many traders treat every trade as a single entry and a single exit, but professional traders think very differently. They think in terms of starter positions, booster positions, and anchor positions. This approach allows traders to manage risk more intelligently, adapt to changing market conditions, and stay emotionally grounded during volatile price action. Trading is not about being right on the first click. It is about building conviction progressively while protecting capital. When done correctly, trading your starter, booster and anchor positions helps traders avoid overexposure, improve average entry prices, and maintain discipline even during uncertain market phases. At its core, this strategy is rooted in probability and risk management rather than prediction. Markets do not move in straight lines. They breathe, pull back, fake out, and accelerate. A single entry mindset forces traders to be perfect. A position building mindset allows traders to be flexible. A starter position is about testing the market. A booster position is about confirming strength. An anchor position is about holding conviction once the trade thesis has proven itself. Together, they form a structured way to scale into trades without emotional decision-making. This philosophy removes the pressure of all in or nothing trading and replaces it with a layered approach that mirrors how institutions actually deploy capital. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and AMP. Use code BLOG to receive 20% off your next purchase. A starter position is a small, low-risk entry that allows you to participate in a potential trade without full commitment. Think of it as putting your toe in the water rather than diving in headfirst. The primary purpose of a starter position is information gathering. Once you enter, the market gives feedback. Does price hold support? Does volume confirm your idea? Does momentum align with your thesis? If the market immediately invalidates your setup, your loss is small and controlled. From a psychological standpoint, starter positions are powerful because they reduce fear. You are no longer watching from the sidelines, but you are also not heavily exposed. This balance keeps emotions in check and prevents impulsive decisions. A well-placed starter position typically occurs near a key technical or structural level. This could be support in an uptrend, resistance in a downtrend, a moving average, or a consolidation breakout zone. The key is that the starter position is not meant to be perfect. It is meant to be strategically early, with the understanding that confirmation will come later. Risk on this position should always be predefined, small, and emotionally insignificant. By entering early with minimal size, you gain market exposure while retaining flexibility. A booster position is added only after the market confirms your initial idea. This confirmation can come in many forms, such as a strong breakout, higher highs and higher lows, increasing volume, or a successful retest of a key level. The booster position is not about averaging down. It is about adding to strength, not weakness. This is a critical distinction. You are increasing exposure because probability has improved, not because price moved against you. Booster positions help improve overall trade efficiency by allowing traders to scale into winning trades rather than overloading risk up front. Adding size to a trade that is already working feels counterintuitive to many beginners. Emotionally, traders are often more comfortable adding to losing positions than winning ones, which is exactly backward. The booster framework retrains the mind to reward discipline and confirmation. You are telling yourself, the market agrees with my thesis, so I will commit more capital. This mindset shift is one of the biggest transitions from amateur to professional trading behavior. The anchor position is the core of the trade. It represents your highest conviction exposure and is typically held for the longest duration. By the time you add an anchor position, the trend, momentum, and structure should all be aligned with your thesis. Anchor positions are not rushed. They are earned. The market must prove itself before you commit this level of capital. This position often benefits from wider stops, longer holding periods, and larger profit targets. Because earlier positions have already reduced your average entry risk, the anchor position can be managed with greater confidence. Many traders exit too early because they fear giving back profits. Anchor positions solve this by separating short-term noise from long-term conviction. While smaller positions may be trimmed or adjusted, the anchor remains intact as long as the broader thesis holds. This structure allows traders to stay in major moves instead of constantly jumping in and out, which often leads to missed opportunities. One of the biggest advantages of this strategy is dynamic risk control. Instead of risking the same amount on every trade entry, risk evolves alongside confirmation. Initially, total exposure is low. As probability increases, exposure increases. Importantly, total risk is still capped. Stops can be adjusted as price moves in your favor, often allowing later positions to be funded by unrealized gains rather than new risk. This approach aligns risk with information, which is how professional traders survive long-term. Position sizing is the backbone of this strategy. A common approach is to allocate a small percentage of your intended total position to the starter, a moderate amount to the booster, and the largest portion to the anchor. However, the exact ratios matter less than the principle. What matters is that no single entry defines the trade. The trade is defined by the combined position and the evolving market structure. This layered allocation prevents catastrophic losses and supports consistent execution. Starter, booster, and anchor positions example. Assume you are watching an asset that has been forming higher lows and consolidating just below resistance. Your analysis suggests a bullish breakout is likely, but not guaranteed. You initiate a starter position as price holds above a rising moving average. Your size is small, and your stop is placed below the recent swing low. Price chops slightly but holds structure. Next, price breaks above resistance with strong volume. This is your confirmation. You add a booster position on the breakout or on a shallow pullback afterward. At this point, your average entry improves and your confidence increases. As the trend develops, price forms a higher low and resumes upward momentum. The trend is now established. You add your anchor position, committing the largest portion of your capital. Stops are adjusted to protect downside while allowing room for continuation. As price continues higher, you may trim the starter or booster positions to lock in profits, while letting the anchor run. This structure allows you to benefit from both short-term and long-term movement without emotional interference. Exits should be just as structured as entries. Starter positions can be exited earlier to reduce exposure. Booster positions can be managed dynamically based on momentum shifts. Anchor positions should only be exited when the core thesis breaks, not because of minor pullbacks. This tiered exit approach keeps you in control and prevents overreaction to normal market fluctuations. The beauty of trading starter, booster, and anchor positions is that it works across stocks, forex, cryptocurrencies, and commodities. The structure remains the same even if the instruments change. Short-term traders may compress the timeline into minutes or hours, while swing traders may stretch it over days or weeks. Long-term investors can even apply this framework to portfolio building. The adaptability of this strategy is one of its greatest strengths. Consistency in trading does not come from predicting markets. It comes from executing a repeatable process. This position building strategy creates a framework that can be applied trade after trade, regardless of outcome. By aligning risk with confirmation and conviction, traders reduce emotional errors, protect capital, and allow winners to grow. Over time, this leads to smoother equity curves and greater confidence. Conclusion: trading your starter, booster, and anchor positions is about more than scaling into trades. It is about thinking like a professional, managing risk intelligently, and letting the market earn your capital commitment. Instead of trying to be perfect on entry, you allow probability to guide your decisions. Instead of reacting emotionally, you follow a structured plan. And instead of exiting too early, you give your best ideas room to work. When applied with discipline, this strategy can transform not just your trades, but your entire approach to the markets. Thanks for watching.